there's always a two-sided risk to the Fed acting,
yes.
right? If it doesn't act, you risk inflation. If it does act, you risk recession or economic weakness. How do you judge the other side, the concern about inflation, that the Fed doesn't act, that perhaps there would be an inflation problem?
Well, I think that is something that the Fed should be aware of. We have a very low unemployment rate. Traditionally, we have seen linkages between the degree of labor and product market slack and inflation. And that's a lesson of history that I think it's important for the Fed not to forget. But on the other hand, the linkages aren't all that strong, and it looks like over the last decade or two, the strength of the linkages between labor market tightness and wage and price inflation has become a much more muted relationship. So, for example, we've seen wage growth move up some as the labor market is tightened, but not a lot. And wage growth is still running just around 3% or slightly over 3%. And, you know, with 1% or a little bit more productivity gain,
right,
you're not seeing pressures on firms' profit margins. Unit labor costs are rising a little bit under 2%. So we're not seeing strong inflationary pressures, if any, emerge. Inflation is still running under, slightly under 2%, close, but after a long period.
So ultimately, it sounds like you're saying that the Fed has the luxury here to be patient and worry more about the downside risk because the upside risk to inflation is not all that present.
Yeah, I would say now that they're in a range of neutral, that it's not necessary to act preemptively. And many people do feel that there may have been a more fundamental change in the relationship between inflation and the labor market. And so waiting to see how does inflation evolve, is there any evidence of upside inflation pressure? So I wouldn't rule out that that could happen. It's possible, especially if we get strong growth this year and the labor market continues to tighten. It's not out of the question that the Fed might need to raise rates again, but waiting to see. And of course, there are risks on the other side. And so this is a time when being data dependent and looking at the data and assessing what it means for the outlook seems sensible to me.
So would you say that it's possible the next move is a cut by the Fed?
Of course it's possible. If global growth really weakens and that spills over to the United States, or financial conditions tighten more and we do see a weakening in the U.S. economy, it's certainly possible that the next move is a cut. But both outcomes are possible.
Let me push you a little further on this, just as a last question on it. If you did this for a long time, so if you were filling out the SEP, the Fed's forecast again, what would you have penciled in for 2019 for Fed policy?
Well, I might have penciled in something similar to the median,
which is
in
two rate
December
hikes.
Was 2 rate hikes. But I would have had a very wide uncertainty band around it. And one of the things that my committee tried to do was to add uncertainty bands around these forecasts, because it's very important for people to realize, nobody is certain what will be appropriate. And I remember that what's going on now reminds me a lot of 2015, 2016. We were on a path, we thought, to begin raising rates in 2015. In the summer of 2015, the Chinese devalued the yuan. There was a tightening of financial conditions. The stock market declined. We had expected that by September of 2015, we would begin raising rates. They've been 0 for 7 years. We waited until December. In December, the median forecast in the dot plot looked for 4 increases in 2016.
And you did none.
We did one.